I think at this moment we should still be very careful about using the W word, meaning starting to say that this is an actual trade war. We are not there yet. We've actually seen some pretty constructive progress there overnight with China, but also in the issue of NAFTA, some very constructive steps there. So we're not there at the point of talking about trade war. It's just that these headlines are not going to go away, and the trade issue is very, very important to our growth outlook.
We have our first tweet.
Oh.
From?
Good morning. We have two. Actually,
from you say from who do you think is tweeting at this hour?
They're quick ones. Attorney-client privilege is dead! Exclamation point from the president, and in all caps with 3 exclamation points, a total witch hunt. That's what we have so far. Okay.
So reiterating the comments he made yesterday at the pool spray.
But he looks like he may have just hit
started.
send there. He may have hit send.
There could be more to come.
I'm listening.
But just going to monitor the
I'm looking at this. If I'm looking down,
so I don't take any offense.
No,
of course not.
Okay.
Have you recommended to clients that they change any of their allocations based on what is going on now and in the expectation of just a higher market volatility in general?
We are thinking about higher market volatility. Trade is one reason why, but I think there's more to it, right? There's also issues around upside risk to inflation, which we're getting this week on Wednesday, issues around the Fed. Can we get a hawkish surprise for this year and the next couple of years? So certainly a higher volatility environment. It still leaves us feeling pro-risk, meaning we want to have some overweight still to the equity market, but perhaps not as high as we did last year when it was a very, very low volatility environment.
So meaning what?
Meaning you perhaps take your overweight to the equity side down a little bit.
To what, though?
So maybe instead of being 10 percentage points overweight equities versus bonds, maybe you take that down to, let's call it 5 percentage points.
Everybody's expecting a good earnings season for Q1. I mean, the estimates already rose during the quarter, right, by roughly 5.5% or so. In terms of the outlook, can we get any sense? I know we haven't gotten to the conference calls and so on, but it seems logical that if you're a CEO or CFO, that you'd be cautious. There's no reason to sort of set the bar high at a time when market volatility is elevated.
Indeed. Well, look, this quarter, 16.3% is the expectation. It's a lot better than what we saw in December. And there's only one sector that's showing anything negative, and that's real estate. And really, nobody cares. I mean, the reality is banks look really good. Yeah, management always does that. They always try and basically, under-promise, over-deliver. Is there an expectation of why they change that? I don't see why. But I will say this. If you think they're coming in at 16, they're not. They're going to come in at 18, perhaps 19%. Earnings are going to be really strong. The consumer has made its best showing in one of several quarters, and it's going to get better in the next couple of quarters. So I think, touching on the point, you got to separate the noise from what's really going on with the fundamentals. And the one final thing I would say is this, and I think I caught it earlier, which is I'm not sure the full market is aware that we've just gone down, basically when you reset on the 12-month forward PE, to 16 times. I would argue that's cheap. That was cheap. Considering where interest rates are and the macroeconomic story going forward and the earnings story, we should be trading at a better premium than that. So that's kind of where we're seeing it these days.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.